Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlet and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why AI is emerging as a catalyst for office space demand despite fears of job cuts.
Plus, we'll discuss what recent 13F filings revealed about Warren Buffett's last quarter as CEO of Berkshire Hathaway.
But first, we begin with news from the farm machinery leader Deere.
This week, Deere boosted its annual profit outlook as the company, which is the world's biggest farm machinery maker, anticipates the agriculture economy will soon get better.
For more, we were joined by Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst.
We began by asking Chris for his take on the latest at Deere.
It was a really solid beat and raise quarter, and I think this kind of gives us the all clear on the cycle, and that 26 will be the trough earnings year. The 1Q beat was broad based, all segments, better top line, better margins than expected, really on the back of higher shipment volumes, with particular strength in the small ag business and construction. Those are markets that have started to already recover now this year. The large ag business, which is obviously their bigger growth engine, continues to be soft, but I think you're seeing that business stabilize. And really, for the first time in years, we're starting to see some green shoots emerge there. Order books strengthened a little bit during the quarter as well.
How does this compare and contrast with what CNH Industrial reported earlier this week, which took it feels like a cautious stance?
Yeah, I think so. Both companies are calling 26 as the bottom. I think that's pretty well understood at this point. I think the incremental piece coming out of Deere is that you're starting to see some early signs of improvement in the North American large ag business. That's a market they're projecting in terms of unit volumes to be down 15 to 20% this year. That's going to put volumes at the lowest level in more than 4 decades. But what you're starting to hear from them this quarter is that the order book strengthened, particularly just in the last month of the quarter. You're starting to see a little bit more trade flows going to China. The fleets continue to age. You have the government aid support. So this is not a big step change, but it's really the first signs of incremental improvement.
You got to have a great sense of timing, Chris. As I said, Deere's up 42% year to date. So the market's anticipating this business bottoming and then turning up. How long is this cycle for some of these companies that you follow here that are cyclical?
Yeah, so a typical downturn in this business will last anywhere from 2 to 4 years. This will be the 3rd year of the downturn. So in terms of the downturn, it looks very similar to what we've seen historically. Typically, the upturns last a little bit longer. But this is an incredibly volatile market, and it's ultimately dictated by crop prices and farmer profitability. So the crop outlooks do have a significant impact here in terms of what farmers are willing and able to spend.
And it looks like Deere relies on the U.S. for a huge part of its revenue, if not half. What is it doing in terms of growing its business overseas? Is it just kind of a trajectory of growth there that is similar to what it sees in the U.S., or is it competing against some established players?
Yeah, so they're regional markets, but in terms of what markets matter for Deere, it's North America, and then South America is becoming more important. Reason being, those are typically the bigger producers of row crops, corn, soybeans. They're larger farms. They utilize more the larger equipment that is more conducive to some of the precision technologies, which come in at a higher margin. Europe tends to be a little bit more stable. They get a lot of government support, so think of that market as less cyclical. Lower peaks, higher troughs. Those are really kind of the 3 big growth engines if you think about Deere's geographic exposure.
So what is Deere saying about the U.S. farmer these days?
Listen, things are still challenging. Let's not understate that. Crop prices really haven't moved that much and still under tremendous pressure as we look at another year of near record production. They are seeing some signs of stability, I would say. And like I mentioned earlier, I think we're starting to see some early signs of improved order activity, again, albeit off a very low base. And a lot of that's predicated on, we're starting to see a little bit more exports go into China. You have continued government support. And then also, there's certainly a need for replacement. The age of the fleet is as old as it's been in a number of years. So as farmers get more money, you start to see some stability on the crop price front. That should, unlock some pent-up demand.
Yeah, I'm just looking at the stock price, trading at a record high, but it really has gone on a tear over the past 3 weeks or 2 weeks. What accounts for that? Was it anticipation of this report, or was it something else?
A combination of things. I think, it's pretty well understood now that this year will be the trough of the cycle. So I think there's some positioning ahead of that. And, a lot of these heavy machinery companies typically do well early in the rate cut environment. So the anticipation of lower rates, stronger growth environment, not only in the ag business, but also construction. I think that sometimes gets overlooked. They're completely refreshing their excavator product lineup. They have a pretty strong position in construction equipment. And I think the growth dynamics there moving for 26 and 27 are still quite favorable.
Our thanks to Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst.
We move next to the retail giant Walmart.
This week, Walmart issued a forecast for full-year earnings that missed higher expectations, flagging the unpredictable state of trade and labor market conditions.
So we brought in Emily Cohn, Bloomberg's Consumer Team Leader.
We first asked Emily for her take on Walmart's most recent results.
It is another solid quarter for Walmart in the fourth quarter. They did come out with conservative guidance, which is pretty typical for Walmart. Come out with cautious guidance and then exceed it later in the year, which is sort of their playbook. And then their guidance was also paired with some warning signs or cautious outlook about the economy, which I found interesting.
Yeah, I want to pick up on that idea because the CFO talked to Bloomberg and mentioned that tariff-driven inflation has reached or is reaching its peak, which I thought was really interesting given that there's so many people expecting rate cuts later on this year, given that inflation seems to have settled down. What more can they tell us about pricing?
I think they told us that prices rose 1% in the quarter, which I think was the same as the last quarter. But they also mentioned other things like tepid job growth, student loan delinquencies rising, consumer sentiment being uneven, things that, would give any CEO or CFO or company pause when they're trying to outlay what might happen in the coming year.
And I noticed over the last, couple of years, they've talked about how maybe their customer base is changing a little bit. People, some middle class, maybe even upper income areas coming down to Walmart. They're seeing more and more of that. Is that still the case?
I think, yes, that's definitely the case. And that's sort of their superpower right now. That, poor, this is the K-shaped economy that we talk about a lot. Poor customers are pulling back in areas, but what they're seeing is wealthier clientele who might not have come to Walmart in the past, shopping at Walmart, especially for things like their groceries, which they've invested in a lot in the last 10 years. You can now find organic groceries, and that's really paying off.
And they also have this Walmart Plus program, which they're really putting a lot of emphasis on. It's actually one of the benefits if you're an American Express Platinum cardholder, which speaks to that idea that they're really reaching for the higher income consumer. How's that going, and is it making any headway on stealing market share from Amazon with its Prime program?
Yeah, they're seeing a huge growth in e-commerce. I think that was one of the major areas that grew this quarter. That is drawing in higher income shoppers who actually pay even more than the membership for faster deliveries, speedier pickup times. And that's helping them also grow market share among wealthier shoppers who are looking for convenience over everything else.
What are they saying about, did they even talk about on the conference call tariffs anymore? Is that still a discussion point? And what's the company saying about tariffs?
Yeah, tariffs came up a little bit, but they said that they, expect that tariff-driven inflation to peak now. I think they also benefit here, again, from their groceries. Yep. Groceries are a portion of their assortment that is less impacted by tariffs. And they're really benefiting from, I think 60% of their sales come from groceries these days.
You mentioned e-commerce. It sounds like Walmart will continue to invest in technology and automation. What were some of the things that they flagged that they're working on in terms of innovation and building on, the technology that they have already implemented into their system?
Yeah, it was interesting. They said most of their fulfillment in stores is now coming from automated warehouses. Most of their fulfillment for e-commerce is coming from automated warehouses. They have really made huge gains here to speed up fulfillment centers. And I think we should expect to see more of that in the coming quarters. They cited store remodels and automation as the main areas where they're going to be continuing to invest.
One of the things that's amazed me really for 10, 15 years about Walmart is how well their digital business has been, their e-commerce business. They have built that to not only, they can go toe to toe with Amazon.com on just about anything, it seems like. Is that still a growth story for them?
Yeah, I think they said something like a third. They've seen a huge amount of shoppers are now actually interacting with their AI.
Oh boy.
Their AI assistant on their app and on their website, that really helping people make shopping decisions faster. They're seeing an increasing spend from customers who interact with the AI shopping assistant, they said, which I think we can expect to see more
just
of
in
that.
the last 5 years, their EBITDA has roughly doubled, but their CapEx has tripled.
Yeah.
So
there's
really
that e-commerce build out, that tech build out.
Yep. So they're putting their money where their mouth is here. Wow.
You know what Paul's dream job is, Emily? Has he mentioned this to you?
No.
Be a greeter at Walmart. See, I'm a nice, friendly guy.
He wants the smock. He wants to wear the smock.
Yep.
But, to that point, Walmart employs about 2.1 million
That's
people,
amazing. Yeah.
which makes it a huge employer. Do we have a sense of whether they've been growing their employee base at all with this commitment to technology, to automation?
I think they've definitely made a huge investment in technology. They have a lot more people working on tech than they ever have. And I think we could expect to see more of that for sure.
That was Emily Cohn, Bloomberg Consumer Team Leader.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
Move next to news from the amusement resort operator Six Flags Entertainment.
This week, Six Flags reported 2025 earnings and revenue that were slightly ahead of analyst estimates. For more on this and the latest in the travel and leisure space, we're joined by Jody Lurie, Bloomberg Intelligence credit analyst.
We first asked Jody for her take on Six Flags earnings.
So I think what's interesting, Paul, is that we're seeing that some of what Six Flags said, oddly, was similar to what we saw on Avis's call. And both companies had these large impairment charges to boost EBITDA, but it didn't necessarily equate to cash generation. And both companies are focused on improving their debt load and also just the core of the business, the operational side, adding in AI to boost the business and figuring out ways to turn around. And both companies are dealing with new CEOs. So it's just like a weird sort of compare-contrast scenario that I've been toying with in my head.
Paul was talking about how Hershey Park was his first amusement park. Yeah. And then obviously the big one would be Disney or Universal. Have you been there?
No.
Okay, that's a pretty good one.
Yeah, I've heard about it. Yep.
Is that the competition for Six Flags, or does it work on a different level than those?
It is and it isn't the competition, Scarlett. I think Six Flags likes to compare itself more to alternatives in leisure and entertainment. There was a great slide that they provided that showcased the value proposition if you compare it to like concert tickets or insert sporting event. The amount of time that you spend at Six Flags in theory is all day, right? So the cost to enter and the cost for the the sort of concessions is much lower than what you would pay to go to like a Taylor Swift concert. Now that said, I think what's so interesting is when the company combined, there was this image that they could create like an all pass promotion, right, that you can enter in all parks. They've only finally started rolling out something that's a regional pass recently, and I'm curious to see what could happen with the company as they improve those sort of points of it. Because what's funny is, if you look at it from a revenue perspective, it did actually pretty well this year compared to 24, and 24 was a pretty strong year. Same thing with some of the per cap spending pieces of it, right? The per cap component, the admissions were down, but the in-park spending was decent. And so you say, what's going on? Like, why are they having such issues? And it comes down to an operational issue. It comes down to the fact that the legacy Six Flags assets, I think, were in way worse shape than Cedar Fair anticipated when they took on the company. And they're saddled with a lot of debt. So it's really a question of if the capital markets are going to be encouraging enough to help them through. You know, they helped them through in January with a new issue. But really, are they able to sort of support the company through this transition?
That park pass you mentioned sounds like the amusement park version of an Epic Pass, which makes sense if you're a skier and you go are chasing the weather around the country. But does it make sense to go to the West Coast for Six Flags and then come back? I don't know.
It could, Scarlet. You don't talk to Ira Jersey enough, apparently, at least when it comes to roller coasters. You probably talk to him about interest rates. Next time when you have him on, ask him about his son's American Coasters Enthusiast card that he proudly carries. If you are deep into the roller coaster dynamics and culture, people will go to the end of the earth. And I am curious to see how the Middle East traction for Six Flags, for SeaWorld, and for some of the other parks that have expanded there, how that's going to play out. If you do see these park coaster enthusiasts fly out to Saudi Arabia, fly out to the UAE to ride certain coasters.
Our thanks to Jody, Lurie, Bloomberg Intelligence credit analyst. We move next to the real estate sector.
Bloomberg Intelligence recently put out research entitled AI Drives Office Demand Amid Job Cut Fears.
And according to BI, AI is emerging as a catalyst for office demand, reinforcing leasing momentum in New York City and San Francisco.
For more on this, we're joined by Jeffrey Langbaum, Bloomberg Intelligence Senior U.S. REIT Analyst.
We started our conversation by asking Jeffrey to discuss what people are saying to him with regards to AI and office space.
Right now, what people are thinking about is what the impact is going to be on office space if AI makes all of these industries that lease office space irrelevant.
Okay.
What does that mean for demand for space? And we saw last week that started with software, and then it went to industry after industry, and ended up with the real estate brokers and eventually the office REITs getting hit hard.
So far, this is just kind of fear that's wafting across the market. Have we actually seen any evidence of this happening?
Not yet. And in fact, we've seen some of the opposite. Leasing velocity has been at the highest level since before the pandemic in markets like New York and San Francisco. The REITs that we follow, names like SL Green, Vornado, Boston Properties, or now BXP, these guys are reporting very strong leasing volumes. We're starting to see occupancies tick up off the bottom in their portfolios. And one of the dynamics at play is that AI firms are leasing space as they grow. And to the extent that companies being impacted by AI start to recede a little bit, there's an offset there.
So your office REIT stocks last week sold off on this fear?
Yeah, and it's not a new fear. I mean, it's been at play for some time now. Work from home kind of worked its way through, and everyone kind of got comfortable with where hybrid kind of settled in, and then what was the next thing to hit office, and it was this, and it's been out there for probably a couple of quarters now. What is the impact going to be? But last week when software rolled over, it just compounded.
Is this something where, because of the evidence that companies are still leasing quite a bit of space, that we're going to see a just as sharp recovery?
Well, that's possible, but there's also the risk that the equity markets are
turbulent
and forecasting, right? And so there is the possibility that there will be negative leasing news to come. It's certainly not showing up in the numbers now, and we do think, and this is backed up by some survey work that we just did last week of office workers in both New York and San Francisco. We actually think that there's still a period of time to come where firms are actually leasing more space. They're expanding their headcount to try and figure out how to take advantage of AI and to grow their business. And that could actually, I don't know about a sharp snapback, but it could, prolong the positive vibes for some time.
What's the sector of the REIT market that you like the most right now?
Senior housing is I mean, it's the one aspect where you cannot refute the demand story at all, and at the same time, where real estate guys typically love to build, to take advantage of those demand stories, there's not much senior housing coming out of the ground. So there's a huge supply-demand imbalance.
Okay, but is senior housing more attractive in certain markets over other markets? How do you pick between winners and losers when it comes to senior housing?
It's really more about the local operator than it is about the specific market. I mean, obviously, if you're in a place where, the economics aren't as strong and you don't have as affluent a potential resident base, then that's going to, potentially impact. But strong local operators, when there's not a lot of supply coming out of the ground, and you basically just have an aging American population that is going to need housing solutions, it's really a play across the board.
All right, thanks to Jeff Langbaum, Bloomberg Intelligence Senior U.S. REIT Analyst.
We move now to some research that Bloomberg Intelligence recently published on American Express.
According to BI, American Express's focus on attracting new premium cardholders should help it meet its consensus EPS growth in 2026 and 2027.
So we brought in Edward Najarian, Bloomberg Intelligence Consumer Finance Analyst.
We first asked Ed about Amex's most recent quarter and what we've learned since the company rolled out its increased fee for the Platinum Card.
When they reported the quarter, great quarter. Everything kind of in line with expectations, or in some areas better, and gave great guidance in terms of mid-teens EPS growth for 2026. And a lot of conversation about the refresh and how great the refresh is going and acquiring lots of new customers. But generally, there were two things that sort of analysts picked on in the quarter when you're trading at sort of a high multiple for financial. And those two things were, number one, that the new card acquisition rate kind of went down a little bit relative to last year and relative to the third quarter. And additionally, all the money that they're spending on rewards and services and all of what they call variable customer engagement expenses went up a lot, a little too much in some people's opinions. So what we kind of learned recently was sort of some supporting data around two things. And the big thing was, while the number of new cards acquired went down a little bit, the fee per new card went up from 196 in the third quarter to 282.
What?
Now, so huge jump. Now, why is that? That's because a lot of a much bigger percentage of those new cards came from new Platinum customers, which is much better than just a regular customer. So even though a little less customers acquired, you're getting many more new Platinum customers, much better economics. So that's sort of one thing. And then talked a lot about how they're absorbing all of those extra reward costs, if you will, but still that's fine because it's enhancing revenue growth, and sort of the revenue growth benefit of that offsets the reward cost, more than offsets that reward cost.
Okay, Edward, one thing that I've noticed from these Facebook groups is that people get a Platinum card that's, for the sign-up bonus and everything else, but then they start branching out and they get the Gold card because there's more reward points for groceries there. They start to compile a lot of Amex cards. So a lot of the users have multiple cards, don't they?
Yeah, no question about that, and obviously you've got a lot of sort of families on the Platinum card. So there's sort of a primary Platinum card owner and then issuer of multiple cards related to that. So you sort of have this sort of network effect of the Platinum card that just keeps building. And to some extent, if you can, when you come back to the JP Morgan Sapphire card, if you can, build that reward and service infrastructure even bigger and better, you create the, sort of the mode effect, which is what they're trying to do and seems to be working.
Hey, Ed, I have the green card I got the day I graduated college. I kept it all. But Scarlet and other folks, I understand, they go crazy for these really expensive cards and all the points and managing that.
You need to go Platinum, Paul.
No, I just can't. I can't do it. But how big of a business is that for these card companies? Is that really the value driver, the Scarlet Foods of the world?
That's it. Yeah. They care much more about Scarlet than they care about you. I have to say, yes.
That's why you need to upgrade.
She's about to pay $895 a year, up from $695 a year. They're going to give her a heck of a lot of rewards and services for that. But
got a big sign-up bonus.
On average, now I hope this is not completely true, but on average, one of the Platinum Card members, spends about 10 times as much on her card as you do.
That was Edward Najarian, Bloomberg Intelligence Consumer Finance Analyst. Coming up, we'll look at why MSG Sports is considering splitting up its Knicks and Rangers businesses.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence through BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
Everyone needs to take care of their mental health, even running back Bijan Robinson.
When I'm on the field and feeling the pressure, I usually just take a deep breath. When I'm just breathing and seeing what's in front of me, everything just slows down. It just makes me feel great before I run the play.
Just like Bijan, we all need a strong mental game on and off the field. Make a game plan for your mental health at loveyourmindplaybook.org.
Love your mind.
Brought to you by the Huntsman Mental Health Foundation, the Arthur M. Blank Family Foundation, and the Ad Council.
With the Bloomberg Small Business Report, I'm John Tucker. There's a historic mansion on the northeast corner of San Francisco's Alamo Square Park where several dozen people live, spending their days immersed in aesthetic concentration. Welcome to HFO, or Hacker Fellowship Zero. The goal is to attract the best entrepreneurs. The Live-In Startup Accelerator promises to strip away all of life's tedium so that founders can have the most productive 12 weeks of their life and birth their real life's work. The program comps living expenses and hands over cash in exchange for equity in each startup operating from its house. The residency, which started in 2020 and just completed its 7th batch, has maintained a relatively low profile, even as it gets thousands of applications for each session's 10 slots. Among those who've attended are a dozen founders who previously built companies with billion-dollar valuations. HFO takes a 5% equity in each participating startup. And that's the Bloomberg Small Business Report.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to some news at the multinational conglomerate Berkshire Hathaway.
This week, the company released its 13F filing for the fourth quarter, and investor Warren Buffett's last quarter as Berkshire Hathaway CEO reflected a bearish sentiment.
Berkshire slashed its holding of Amazon by more than 75% in the fourth quarter, while also building a stake in the New York Times.
Berkshire also continued trimming Bank of America and Apple during the quarter, while increasing its stakes in Chevron and Chubb.
For more on all of this, we were joined by Matt Palazola, Bloomberg Intelligence Senior Analyst.
We began by asking Matthew if this will be the last time we mention Warren Buffett buying or selling shares in companies.
Yes, it is. So he was the CEO as of the fourth quarter. So these moves that we're looking at in the 13F took place in the fourth quarter of last year. To be totally fair, he's been stepping back. He probably wasn't behind a lot of this anyway, but this is actually the last quarter that you could even attribute these things to him. He remains chairman, so you never know. He'd be looming behind the scenes, but his last quarter as CEO.
He famously said he was only investing in things that he understood and that typically did not include technology companies. But Apple, I guess he saw more as a consumer company than anything else.
Yeah, I think so. And I think his thing was moats, right? And probably still is. But the iPhone moat and the infrastructure built in, I think those were appealing things. They have been pairing that investment, as we know. Part of that, and it's kind of a twist because he had said this at the annual meeting a couple of meetings ago, that it was a kind of tax reasons, that they had these huge unrealized gains in there, and that he thought taxes would be going up. Now, they're certainly not going to go up under the current administration kind of anytime soon, but Buffett is always long-term thinking, so I think that's what he was looking at, is we've got, tens of billions of dollars of unrealized gains that will be taxed, and I think it does still hold true that in 10 years from now, probably the corporate tax rate could be higher. And I think that was his concern and part of the reason they were taking down those big gains and those big positions.
The conglomerate also cut its Amazon stake by 75%.
They did.
Wowzer.
So Amazon, they initially got into Amazon in 2019. That was one of his investment deputies, I think, brought it to him then. Again, also like tech, but a retailer, right? Yeah. that position we calculated was up about 130 to 140%
Nice.
over the time they hold it. Nice, but kind of in line with the S&P 500. So it didn't really outperform. So I think it was kind of taking some money off the table. They sold, I believe, like 1.7 billion worth of that stock, cutting most of the position. So that one I think was probably company specific, didn't really outperform. They bought 4 billion of Alphabet last quarter. So, the kind of tech aversion, may be changing over time.
What did he increase stakes in?
So two big ones, Chevron and Chubb. So Chevron is their fifth biggest holding, I think. They, interestingly, I don't know if they were kind of betting on U.S. intervention in Venezuela, which happened kind of after the quarter. So you can't say that like Maduro got taken out and this stuff happened and they did it in reaction. They did it before, but maybe they were reading the tea leaves there. I don't know. It's a big holding for them. I think the kind of geopolitical energy play makes total sense. The other one is Chubb, which I don't want to get too excited thinking about a insurance mega deal here, but they are now they've been the second largest holder of Chubb stock. Chubb makes total sense. It is, in our view at BI, cream of the crop insurance company, global reach, still growing nicely, great management. Like, it's a company that Berkshire would want to own. Now, Berkshire's got their own massive insurance business.
Yes.
The interesting thing is you've got two massive insurance businesses. They're actually quite complementary if one were to want to put them together. So the Berkshire business, very big personal auto in Geico, very big reinsurance, kind of global reinsurance. Those are two businesses that Chubb is not really in. There's some overlap in the kind of U.S. specialty businesses that they're both in, but it would be phenomenally complementary of those two businesses. I think there's probably a lot of hurdles to some sort of total deal there. Chubb's market cap is 130 billion. Berkshire has 300 billion of cash, so they theoretically could buy Chubb in cash if they wanted to. But I think it's probably some cultural issues, and would Chubb really want to sell is the other thing. But it is something. As a stock, something Berkshire would want to own.
Is that a strategy that Berkshire actually follows through on, where it starts off with a stake and then eventually decides, you know what, we're just going to buy the whole thing?
Scarlet, yeah, they do that. So I think with Burlington Northern, which is a little bit before time when they bought it, they did things like that, where they acquire the public stake and then they build it over time. That's why there was a lot of speculation about Occidental. Buffett then came out and threw cold water on it saying that, but it seemed like it was going along with their playbook of huge acquisitions that they made before. So
right.
You never
now
know.
that Warren's out, can we have a serious discussion about a dividend?
We can. I think, we'll get you on the phone with Greg Abel and see what he says.
You're
but,
right.
I think our take has been in the early years, Abel will probably adhere to the ethos of Berkshire, and I don't think he's going to come in and start breaking down walls. I don't think anyone would like to see that, especially if Buffett's still there. And they have tremendous excess capital. Buffett has praised Abel as being a great capital allocator, great capital manager. And they've also said we literally can't, there's so much money we can't put it to work in a reasonable way. So it would make sense to see something happen there. And I think, look, the other thesis is they're not going to be as good at anything anymore, right? There's no better investor than Buffett. You have Ajit Jain, who is the head of the insurance operations. He's been selling a lot of stock. Perhaps he's getting close to retirement. So they're not going to be good at any of these things anymore.
Right.
Some sort of capital return would be a big catalyst.
Our thanks to Matt Palazola, Bloomberg Intelligence Senior Analyst.
We move next to some news in the business of sports.
This week, we heard that Madison Square Garden's board of directors approved a plan to explore splitting the NBA's New York Knicks from the NHL's New York Rangers.
It's a move that would make each team a separate publicly traded company.
For more on this, we're joined by Randall Williams, Bloomberg Business of Sports reporter. We first asked Randall to break down why this deal may happen.
Yeah, you look at the enterprise value of the Knicks and Rangers and what they're traded at, it's $7 billion. But you look at what the Lakers sold for alone, $10 billion. And I think the Knicks obviously are in a larger market than New York. The Lakers have won more titles, but New York is New York. And so both the Knicks and the Rangers, I think, would carry a tremendous value, maybe $12 billion combined. And that's on the low end.
So is this maybe a first step for selling one of the teams, selling a piece of one of the teams?
Getting into speculative territory
well, it's
there.
with James Dolan. That's always a fun place to play.
Look, I mean, Silver Lake owns a piece of MSG Sports. And so that's 5%, or it's a 10% stake, but probably 5% each. And when you think about someone wanting to buy into that, you would want to know how much each individually is worth. If not, you're buying into something, and it's like you could be buying in at a supreme price, or maybe something that's a little bit lower. And I think buyers who are interested, and there have been several over the years, want a more precise price, and so do the shareholders of MSG Sports.
So what's held up the company from being split up until now? Because there's been a lot of calls for the enterprise value trading at a discount to the actual value of each franchise has been there for a while.
I know the answer.
No,
Tell us.
Super voting stock is from the Dolan
control.
family.
Yeah,
Control.
I think that James Dolan has long been the controlling person for all of these companies. Yep. He decides
for better or for worse.
Yes, exactly. He decides, what he wants to do, and there is a board of directors that voted on this, but this would have never been up for a vote had James Dolan not said, you know what, maybe we should consider this. And then from there on, things happen, and then they vote on this.
Madison Square Garden and James Dolan, did they own the garden itself, the building?
Believe so.
Yeah, because that's always a big part of it too. Do you own the arena that you plan, or do you?
Right.
Yes, I had a.
But in a different publicly traded company.
Exactly.
Right? That's the thing.
Exactly. And I had a Bloomberg terminal reader, and the original copy that I wrote, I said Madison Square Garden was one of the most famous arenas in the world. And someone quickly replied and said, no, it is the most famous arena in the world. So Madison Square Garden is a huge attraction. Yep. When you think about arenas in New York. There's the Barclays Center, of course, which is newer, but the legacy of New York is often rooted in MSG and the events that it's held over many, many years.
Yeah, I mean, first of all, and they also put in, I think, close to $1 billion in renovations several years ago. So they really upgraded the garden. And what's one of the many great things about going to the garden is they have the photos on the wall, the concourses of all the great events, whether it's a concert, a game, whatever. And there's thousands of them.
There's no venue that has a greater history, I would argue, than Madison Square Garden that is still, open and operational. And that's part of this. I mean, you think about the Knicks playoff run last year. You think about the Rangers and what they've done. Not the past 2 seasons, but in the seasons before that. All of these things, when they eventually win, God willing, it isn't MSG. It isn't one of the deals where they're in a away game and then they have to come back. If it happens in MSG, that will probably be the biggest moment in that arena in the last 25 years. And so whoever wants to buy into that potentially is going to want a good value at it.
There was also a note from Lightshed that pointed out that there's a new tax law that goes into effect for the 2028 fiscal year that, for public companies, limits deductions to $1 million per covered employees. For sports teams, it's easy to find a lot of employees that make at least $1 million a year. So once this goes through in 2028, that's going to put the company in a negative free cash flow situation, unless the Knicks, for instance, go deep into a playoff run or the Rangers go deep into a playoff run. So it also allows the company, for tax reasons, to be in a better position.
Absolutely. I mean, there's not a lot of publicly traded sports companies out there for this reason in particular. And you think about all of the big ones. You think about the Kroenke Sports and Entertainment, which houses the Rams, the Nuggets, I believe another soccer team, and so many more. It's private, and that's for a reason. But this one is unique, and Madison Square Garden is Madison Square Garden, and Knicks are the Knicks, and the Rangers are the Rangers.
Our thanks to Randall Williams, Bloomberg Business of Sports reporter.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.